Hey traders, welcome back. Today we're breaking down one of the most important concepts in price action trading. A liquidity sweep is when institutions push price above a resistance level, just enough to trigger your stop loss, then dump it back below. The breakout is the bait. The close back inside the level is the actual trade. Let me show you exactly what one looks like. Here's the most recent example, Google 10 days ago. Look at this, the $403 level had been tested 3 times. Then, on May 18th, Google punched above to 408. Looked like a textbook breakout. Then collapsed back inside the same day, closing at 396. That candle, the one that closes back below the level it tried to break, is the trade. Let me show you the mechanic behind it, then we'll walk through 3 more recent setups. Here's why this happens. The mechanic, step 1. When price hits a level multiple times, retail traders put stop losses just above it. Thousands of stops sitting up here, waiting. Step 2. A big institution wants to enter a $50 million short. They can't click sell, they'd crash the price. They need buyers up here at a high price. Step 3. So they engineer the sweep. They push price above the level. Every retail stop fires. A triggered stop is a forced buy. The institution sells into every one. 50 million filled at the top. Step 4. Once they're filled, they let go. Price collapses. The candle closes back below the level. That close is the exact moment they finish. And that close is your trade. Walk through Google with me, candle by candle. Pull up your Google chart on the daily time frame. Find May 13th. Google hits $403.70. The candle puts in an upper wick, gets rejected, closes lower. Now May 14th. Google tries again, hits 402.93. Same thing, rejected, closes lower. May 15th, tries one more time, hits 403, cannot punch through, closes red. 3 rejections of the $403 level in 3 days. Every algorithm watching this stock now knows 403 is the level. Every retail trader watching this stock now knows if it breaks 403, it is going higher. So they put their stops just above it. Then comes May 18th, the trap day. Google opens at 395, rallies all morning, breaks above $403 by mid-afternoon. Pushes higher, 404, 405, 406. Stops are firing everywhere. Peaks at $408.61. Every stop loss above 403 is now triggered. Forced buys flooding the tape. Then, in the last 2 hours of the trading day, Google collapses, 398, 397, 396. It closes the day at $396.94. A $12 upper wick on a $1 body. The candle closes below the level it tried to break. That close is the entire trade. If you shorted Google at that close with a stop above 408, you risked $12 per share. Over the next 4 days, Google dropped $9 more. Anyone who bought the breakout at 405 gone in hours. Now let me prove this rule is not just for Google. Same rule, different ticker. Netflix. April 16th, 2026. Look at Netflix on the daily chart. Netflix had been chopping around 106 and 107 for several days. On April 15th, it tested $107.85 and got rejected. Then April 16th, the trap. Netflix opens at 107.47, rallies, punches above the level to $108.95. Looks like a breakout. Retail buys. Then the close. The close is the whole story. Netflix closes at $107.79. Below the level it just broke. Wick of $1.16. Body of just 32 cents. That is a 3.5 times rejection. Identical pattern to Google. Now watch what happens to anyone who shorted that close. Stop above 108.95. Risk $1.16 per share. April 17th, Netflix opens lower. Drops to $97. April 21st, $92. April 23rd, $92. 2 weeks later, Netflix is trading at $93. That is a $15 drop on a $1 stop, roughly 13 times your risk. In Netflix, a name everyone watches every day. Same rule, different ticker, same outcome. The mechanic does not care which stock it is. One more proof. And this time it is not a stock, it is Bitcoin. Same rule, different asset class entirely. May 6th, 2026, Bitcoin daily chart. On May 5th, Bitcoin tested $81,751 and got rejected. Then May 6th, the same exact pattern as Google and Netflix. Bitcoin opens at 80,900, rallies, pushes above the level to 82,792. Crypto Twitter celebrates. The breakout is here. And then the close. Bitcoin closes the day at 81,427, closed back below the level. A $1,300 wick on a $500 body. Same signature. And what happens next? Over the next 10 days, Bitcoin drops to $78,100. That is $3,400 lower than where the sweep closed. A clean short trade in crypto identical to the stock setups we just looked at. The mechanic does not care about the ticker. It does not care if it is a stock, an ETF, a futures contract, or Bitcoin. Wherever there is enough liquidity for institutions to need stop hunts to fill, this rule prints money. And that is everywhere with a real market behind it. Now the most important part of this video, because if I just showed you 3 winners and stopped, I would be lying to you. Every rule has losers. The honest question is, how often and why? Let me show you a recent loser using the same rule, same stock, Google, but this time 3 weeks before the May 18th trade, April 29th. Google had tested $353.18 the day before. Then April 29th punched to $355.79, closed back inside at $349.94. On the chart, this looks identical to the May 18th setup. Wick rejection, close below the level, textbook. So you took the trade, you shorted at 350. Stop above 356. And what happened? Within 3 days, Google was at 370. Within a week, 388. Within 2 weeks, $400. You were stopped out for a $6 loss. The signal was textbook, better than textbook, but the context was wrong. Let me show you what that means. Pull back to the weekly chart. Look at Google over the past several months. It was in the middle of a recovery rally. Every dip was being bought aggressively. The broader trend was up and accelerating. Your 1-bar bearish signal got steamrolled by a multi-week bullish trend. The rule was right. The context was wrong. Which brings us to the most important filter you can apply on top of this rule. Here is the filter. Add 1 line to your chart. The 50-day moving average. Look at the same Google chart. April 29th, the trade that lost. Price was above the 50-day moving average and the line was rising. That means the broader trend is up. Skip bearish trades when the trend is against you. Now look at May 18th, the trade that won. Price was right at the 50-day moving average and the line was flat. Trend not against you. Take the trade. One simple rule. If price is above the 50-day and rising, skip. If price is at or below the 50-day and the line is flat or falling, take it. The technical signal is necessary, but the broader trend has to not be fighting you. Here is your full playbook. Print this. Tape it to your monitor. Step 1. The level you are watching must have been tested at least once before. Do not trade fresh highs that have never been challenged. Wait for a real tested resistance level. Step 2. When price breaks above that level intraday, do absolutely nothing. Sit on your hands. Do not buy the breakout. Do not short the breakout either. Just watch. Set a price alert and wait. Step 3. If the same candle closes back below the level by the end of its session, that is your short trigger. Step 4. Check the broader trend one more time. Above the 50-day moving average and rising, skip the trade. Below or flat, continue. Step 5. Entry on the next bar open. Stop loss 2 cents above the sweep candle's high. Target the prior swing low. That is the entire system. 5 steps, 1 rule, 1 filter. Repeat every single time. The edge compounds. Let me leave you with the one sentence one more time. Don't trade the breakout. Wait for the close back inside. Check the broader trend isn't against you. 3 sentences. 1 rule and 1 filter. That's the whole edge. Drop a comment if you can think of a recent sweep you missed. Tell me what ticker and what date. We will look at it together in a future video. And if this clicked for you, subscribe. Next video I'm breaking down volume profile the same way. Real data, current setups, 1 rule. Catch you next video.